So this question, Aron, again, past exam question from Mr. Holt, the examiner, and it's very similar to many Part B questions. It's likely to be a question number 2 or question number 3. It's not really a topical issue as such. But what we've got to do, I mean, the examiner's done quite a lot of the work for us. He's already broken it down into 1, 2, 3, 4. He's already broken it down into 5 parts. So it's not a 25-mark question. It's a bunch of 4 and 5-mark questions, and we're going to pick off those marks one by one. So we start off, it says briefly. Now notice it says the word briefly. If you take a look at the model answer is 6 pages long. That's not very brief. So I'm going to do it briefly. Briefly discuss how the fair value of financial instruments is measured, commenting on the relevance of fair value measurements for financial instruments where markets are volatile and illiquid. So I'm going to break that down into 2 smaller questions for 2 marks each. So we start off, we're looking at the measurement of financial instruments. What's happened? Financial instruments are measured at using either fair value or amortized cost. 1 point worth 1 mark. Fair value is the arm's length price between 2 parties in a market. IFRS 13 identifies three types of market. One, we've got a type 1 market. Here we're looking at identical assets in an active market. So there's lots of transactions. This is usually the case for equity shares in a listed stock exchange. Because one share in Mercedes-Benz or Nestle or Microsoft is exactly the same as another share. So it's like they're identical assets and there's lots of transactions. Now I'm doing far more than 4 marks worth here. I'm trying to give you a bit of IFRS 13 knowledge as well. Secondly, we've got a type 2 market. This is an observable market. And there's two elements to it. Either we have similar assets to ours in an active market, or we have identical assets to ours in a non-active market. So here perhaps we could be looking at shares in a private company. There's not many transactions taking place, but we've got identical assets. Or we could have a similar company to ours whose shares are being traded on an active market. It's not as desirable, is it? It's not as accurate. It doesn't give us as much comfort as a Type 1 market. Type 3 is an unobservable market where we use judgment and predictions to measure our assets. And we're not very comfortable at all. Yeah, how much is a share in that company worth? It's, well, what I think, or it could be I've done some calculations based on a spreadsheet using assumptions which I've come up with. It's my opinion. Doesn't give me a lot of comfort from an independence point of view. So I've written more than was required there, simply because I wanted to give us a little bit of background on IFRS 13. The second issue, it's spoken about volatile and illiquid markets. A volatile market is one where prices move rapidly, fair values give us reliable information for the price of the financial instrument for one day only. Such information is not necessarily relevant as it is quickly outdated. Illiquid markets are those with few transactions. Fair values may be both failing to be relevant or reliable. Because it could be that on a particular day only a few shares are being traded, Nobody's wanting to sell, so therefore we end up paying an artificially high price. So there are problems with using fair values. Equally, there are problems with using the alternatives such as historic cost. Historic cost is just far more out of date. So I've got 4 marks worth of time. Should have taken 7 minutes. I've taken 10 minutes, but I've given far more than 4 marks worth of answer there. Let's now move on to part B. So we're looking at convertible bonds. Notice the date. These bonds were issued 3 years ago. They matured and converted on the 31st of May 20x8. So they're effectively being converted at today's date. We separate into debt and equity elements. And as is often the case with the examiner, there's a little twist to the question in the form of issue costs. But if you've just ignored the issue costs or just deducted them, you would have picked up something. Stick to the basics and pick up as many marks as you can. Step 1. We calculate the debt. So what's going to happen here is the bonds have got a term of 3 years. The coupon rate is 6%, but a similar rate for a non-convertible bond is 9%. So what we're going to have is year 1. 100 million times 6%, so it's 6 million discounted at 9%. So that's 5.50 million. Year 2, 6 million, discount that for 2 years. And then we do that for 3 years. 4.63. So we've got 5.5 plus 5.05 plus 4.63. Oh, sorry, that should be the repayments. That should be 106 million. So 106 million divided by 9% for 3 years. So that gives us a figure of 92.4 million. Step 2. We calculate the equity. So we're going to receive cash of 100 million. Credit the liability 92.4, and we're going to credit equity with the balance, which is 7.6 million. It's at this stage we get the twist. And if you've ignored the twist, you'd have still picked up 5 marks out of 6. So don't stress about something which you perhaps haven't seen before. The issue costs should be charged on a pro rata basis against debt and equity. So we credit cash 1 million. We debit the liability 0.924 million because it's 92.4% of our total. And I'm going to debit equity 0.076 million. So we do that in exactly the same ratio as the way that we've allocated the proceeds of the debt issue. We now move to step 3. We calculate our year-end liability. So when did these bonds arise? 1st of June X5. How much have we borrowed? So therefore the net debt is 92.4 minus 0.924. So I've got a net debt. We have borrowed 91.476. Now, if you'd put in 92.4 and you've used the interest rate of 9%, you're going to get the right answer. You just lost 1 mark. The principles you demonstrated are always the same. Our statement of profit and loss account interest is now the effective rate of 9.38%. So that gives me a figure of 8.580. In terms of cash, the bond is paying interest at 6%. X6, we've got 94.056 times 9.38%, so that's 8.822. X7 96.878, 5.0938. Six. And it's close to 100. So it's actually 9.3864% if you actually work out the numbers. So we're approximately there. At maturity, all of the bonds were converted into 25 million ordinary shares of Aron. So then we've got the conversion into shares. On the 1st of June, X8. What's going to happen here is we're going to debit our liability with 100. We're going to debit equity. What figure have we got in equity? We've got a figure of 7.6 minus 0.076. We're then going to credit share capital. And it says the maturity, or sorry, the conversion rate is interest is paid annually. I'm trying to find the conversion rate here. Oh, the maturity, all of the bonds were converted into 25 million ordinary shares. So we're going to credit share capital, 25, and we can credit share premium with the balancing figure. So I've got 107.524 less 25, 82.524. So there's quite a lot to do there, but it's number crunching, and if we know how to deal with a convertible bond, then I think you've got a good chance of getting 5 out of 6 at least. Next, we've got the investment in smart. The investment was classified as an investment in equity instruments and at a carrying value of $5 million, brought forward from the previous period. We are taking gains and losses to OCI, so that's perfectly acceptable. And we have a brought forward gain of 400,000, and we then effectively sold our shares. So what I would say here is that we should de-recognize the investment in smart because we no longer have the risks and rewards of ownership. We should replace this with a new financial asset in the shares in given. So the shares are currently in our accounts at a value of 5 million. We have received shares in given worth 5.5. So what I'm going to do is I'm going to debit financial asset given 5.5 million. I'm going to credit financial asset Smart 5 million, and we have made an election to take gains and losses to OCI. So let's credit OCI with our gain on disposal of 0.5 million. We can make a transfer of our total gains in Smart via a reserve transfer. So what I'm going to do here is I'm going to debit other comprehensive earnings, and we've previously shown gains of 0.4 million, and we're now showing a further gain of 0.5 million. So I'm going to debit OCE 0.9 million and credit retained earnings 0.9 million. So that's another 4 marks. So we've now done 14 marks worth of work. 14 marks is 26 minutes. Just about on target. The next item is GAL. We have a foreign subsidiary. GAL has a functional currency which is the zloty, and it owns a debt instrument which is held for trading. So what are we asked to do? It says the company wishes to know how to account for the instrument in GAL's financial statements and the consolidated financial statement. There's 2 questions here, so let's give them 2 answers. Treatment in the books of GAL. The debt instrument should be measured at fair value through profit and loss, because GAL's business model is held for trading. Now remember, our business model test says if it is our intention to collect the cash flows from the debt, then you choose amortized cost. But we've failed that. Held for trading is we bought it with the intention of selling it. So it's failed the business model test. Therefore, you've got to use fair value through profit and loss. The debt instrument was carried at 10 million zloty, but it says at the 31st of May XA, the fair value of the debt instrument had increased to 12 million. So a gain of 2 million zloty should appear in GAL's statement of profit and loss. If we take a look at the consolidated accounts, in the group statement of profit and loss, the 2 million zloty gain will be translated using the average exchange rate for the year of 2.5. We will therefore show a gain of 2 divided by 2.5 equals $0.8 million. In the group statement of financial position, we use the closing rate because the debt instrument is monetary in nature. At the 31st of May X7, it would have been valued at 10 million divided by 3, because at the end of last year our exchange rate was 3 zloty to the dollar. So that gives us a figure of $3.3 million. At the 31st of May X8, it would have been valued at, we're now at 12 million zloty, but there are 2 zloty to the dollar. So it's now worth $6 million. Therefore, we debit our financial asset $2.7 million. We've credited our statement of profit and loss already with 0.8 million, because the reason why the assets increased in value is 2 reasons. A, it's gone up in value, and B, exchange rates have moved. We will credit OCI with the balance of 1.9 million. This represents the exchange gain. And remember, exchange gains in relation to consolidating foreign subsidiaries are always taken to OCI. So that's another 5 marks. And then we have the employee loans. It says Aron granted interest-free loans to employees on the 1st of June for 10 million. The loans will be paid back in 2 years' time by employees. The market rate of interest is 6%. The company is unsure to account for the loan. So, This is an employee benefit. And therefore should be treated as part of employee costs. Aron is entitled to collect cash flows and intends to collect them. So it should use the amortized cost method. Remember when we were looking at measuring debt instruments, we've got our two tests. What's our business model, and are we entitled to agreed amounts of cash on agreed dates? Well, we're agreed to get the 6 million back in 2 years' time, and it's our intention to collect it. We've passed both tests, and therefore we're going to have to apply the rules. This is the amortized cost method. At the 1st of June X7, we therefore credit cash, 6 million, and we're going to debit a financial asset. How much is that going to be? It's 6 million. The rate of interest is 6%, but it's going to be for 2 years, which gives us a figure of 5.34 million. And the remainder we're going to treat as accrued income of 0.66 million. So it's not, although we're physically going to receive no interest, we're not going to treat it that way. At the 31st of May X8, we unwind the discount stroke interest What have we done? Sorry, we have not borrowed, we've lent. $5.34. We've got our interest at 6%. $0.32. How much cash are we going to receive? We're going to receive nothing because the employees are paying us no interest. So our SFP financial asset is 5.66 million. So that's going to be at the 1st of June X7. You don't have to do it for this second year, but we've now got 5.66 times 0.06 gives us 0.34 received cash. Yep.
The loan is 10 million and you credited 6.
Oh right, so I have. Yeah, I don't know why I've done 6 million. Sorry, I've had a senior moment. So that should be credit cash 10 million. That should be 10 million spread over 2 years. So I don't know why on earth I did that. I'm glad one person spotted it. So that's going to give us 8.9 million, and we're going to debit accrued income 1.1. Exactly the same principles apply. So let's just do these calculations again. So we've lent 8.9 million. Our interest is 0.53. We've got no cash, and we're up to 9.43. The following year, 9.43, 0.57, and it takes us up to 10. So that is how to deal, and this is a classic section B, question number 2 or question number 3. They're quite busy questions, but even making an error, which takes me a couple of minutes, and even giving you far more in section A than would ever be required,